Welcome to TheoTrade. This is Don Kaufman. It's January 6th, 2020, and you are watching the TheoTrade evening video. There's about 9 minutes left inside of today's trading session with an unrelenting move to the upside. S&P is up about 875. The Nasdaq futures up about 50. As I said, with under 10 minutes left to play in the period, why is it unrelenting? I mean, you just have to stand back in awe looking at this and say, hey, can anything stop this marketplace? And that's a reference to all the geopolitical risks that we've seen in the last two trading sessions, effectively, being wiped completely clean. What am I referencing? Well, for this, I want to cruise over to the spiders, and just give you a reference point of the last couple of trading sessions. So here we go inside of the spiders. We'll get very, very specific. Here is January 2nd, which is effectively the first trading day of the year. Obviously, some of the geopolitical risks hit on a Friday, and here we are once again on Monday. We're right back to it. I mean, people, we are literally, within a stone's throw of the all-time high of the S&Ps. Now, as a trader, as an investor, yes, I'm a little bit bothered by it. And this is not about being bullish or bearish, but I believe at this point in time, as a trader and or investor, you have to be extraordinarily careful about some headline risks that may or may not come out. What I'm actually referencing in this case is the threat of possible retaliation, in the Middle East and the broader impact on the marketplace. And I'll take you through just a brief exercise of what I would look at in this particular case. Maybe you assign only a 10 or 15% chance of something occurring, but whatever does occur could impact the market quite substantially. And one of the things that's unusual in the circumstance that I'm seeing right now is not only isn't the market pricing in any of the risk. Obviously, on a price basis, they're not pricing in really any of the risk in terms of, the volatility either. I mean, if you take a look at the volatility, we'll specifically look at the VIX. The VIX is like it never happened. Because again, if you look at previous trading sessions, right there is January 2nd. Here we are right now. It never happened because all of this risk hit, of course, on Thursday evening, Thursday afternoon into Friday. This was the trading session that we spiked all the way up into the 16 handle. We even saw 16 briefly. The VIX is completely contracted. So here we have, again, an instance where the marketplace is almost pricing like zero probability of anything occurring, at least anything that's occurring that's going to sustain risk to the broader marketplace. And there actually lies a very interesting opportunity. So one of the things I try to do is maybe handicap again. If you think there's a 10 or 15% chance of retaliation, I mean, that could actually mean as much as a 5% move inside of the S&Ps. Now, I've been in very similar circumstances time and time again. And more often than not, the marketplace does, take the market itself down and or raises the implied volatility just given that outside 10 or 15% chance, which quite frankly, I think you could probably make an argument that the probability of retaliation is substantially higher. But right now, the marketplace is telling you something very interesting. They're saying, even if there is retaliation, it simply doesn't matter. I'm just going to keep staring, laughing, and keep right on going because if there's retaliation, don't worry. The Fed, they'll have our backs. It is, again, an unrelenting marketplace, and you really have to think, can anything stop it? At the same time, though, as I said, I believe that this is a decent opportunity. Let me show you. First and foremost, about a 5% down move inside of the spiders. That would amount to, it's a $323 product. And so you're looking at about a $16 move. A $16 move in this particular product, takes you down to the neighborhood here, probably somewhere like 307. If you were to see a 5% drop, that's a fairly precipitous and fast drop. So the 307. But, looking at this, I looked at the option chain a little bit earlier, specifically inside of the spiders. And let's say, in the next month, that you thought something was going to occur. Just to kind of prove a point over here, the marketplace is pricing in a little bit of skew, meaning that these out of the money puts, okay, the out of the money puts out here, you can't just go out there and buy out of the money puts and then get down on your hands and knees and pray and hope something big happens to the marketplace. It's just not going to pay you. It's not going to pay you because, the at the money implied volatility is kind of dead, but this out of the money implied volatility, they're pricing in a little bit of tail risk right now. What that kind of means is these out of the money puts, they're being skewed a little bit higher just in case. So a 30-day put all the way out at like the 307 level, which again, you're looking like 5% lower. And the spiders are still trading for $1. That is not gonna really like strike me as something I want to go out there and just outright purchase. What you could do if you wanted to take that outside shot, or if you needed a hedge, you could come 30 days out, okay, and you could buy yourself a rather inexpensive, okay, put spread. I mean, this is a big out of the money put spread. Now, this would predominantly be used as a hedge, okay? How wide is that put spread? I mean, listen, you can go $5, $6, $7, $8 wide, and it's only trading, okay, for about 96 cents. To me, the put spread, although limited in what you can make, is a much better opportunity than taking a shot at the dark at like the 307s. It's rare. It's really rare that I would talk about buying an out of the money put spread for the next 30 days. But as I said, if you're thinking to yourself like, all right, there's a 10-15% chance of this retaliation, the market really could come off hard and fast over there, as much as like 5% in a very short period of time, then something like this 315, 307 may actually work out very, very nicely for you. But you have to be willing to part with every ounce of that 95 or 96 cents. And again, that could be a short-term hedge for you if you need that downside kind of hedge. So the other aspect is I was bringing to your attention is that like volatility isn't necessarily pricing this in at all. I mean, the VIX, the activity in the VIX today is lackluster. There's 300,000 contracts in here, but the VIX subsided, if anything, with the S&Ps, up some 10. The one aspect that I see is also could be bearing some fruit here. Now, this is a highly experienced trade. So I just threw a nice, gentle, okay, put spread in the spiders at you. I think anybody could probably, grab the idea of the put spread. This one's going to get you a little bit. So there's a trade if you have the ability, if you understand this. I would actually look at buying the 16-day vol futures and selling the 44-day vol futures. That is the opposing trade that most of the professionals that are in right now. A lot of professionals are actually short 16-day and long, okay, the 44-day as a hedge. In this case, I'd actually be long the 16-day, okay, and short the 44-day. Why, okay, would I do that? I would actually look for a decent and fast convergence. If there's going to be anything that's going to rock this marketplace, you're going to feel it right here in these volatility futures. And I have to tell you, these volatility futures, they're so wide between the 1490, okay, and the 1675, you could drive a truck, okay, through the gap in that thing. It is wide, people. And again, that's kind of an advanced trade. It's kind of a trade that's going to eat up a little bit of margin in there. If you've never looked at volatility futures, well, volatility futures are volatile. They run very often at about a 100% implied volatility. Most of you are not used to trading Mr. Toad's wild ride, and that's exactly what you get inside of those volatility futures. Here comes the closing bell. It's over. The S&P's up 11 in today's trading session. So those are just two quick ideas in a marketplace that's just unrelenting, unforgiving to the upside. One aspect that did change today, and I do want to take you into it here briefly, is inside of the financials. As I said, the markets, they can't do very much unless the financials are involved. And the financials today ended the day massively unchanged, okay? And that's the only reason that the S&Ps are not up, okay, 30 points. You have the monsters of tech, your biggest technology stocks out there, all-time high today, all-time high. You can take a look at the Nasdaq. If you take a look at the Nasdaq, and it's worth bringing this to your attention. Nasdaq is just a hair off the all-time high, but the monsters of tech themselves are at the all-time high. And the reason I bring this to your attention is because the market as a whole can't do much without those financials. This week, I'm going to reiterate something I talked about last week. Eyes on the financials, okay? They have been lackluster. in the last, what? You're now at 3 weeks of trade. You're into the third week of trade. You got 1 week. What did they do? Nothing. You got 2 weeks. What did they do? Nothing. Here, okay, kind of a shortened week. We are now, again, doing absolutely nothing in this beginning of the week inside of the financials. But if you want to see if volatility is really going to pick up in the broader S&Ps, the financials have to crack outside, okay, the edge of the expected move, which this week falls directly on 30, okay, 30 inside of the financials that crack under that expected move. People, you got yourself some sell side activity. A lot to think about with all of these geopolitical risks. But really, the big question, can anything, of course, stop this marketplace? Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.